I'm in the dark, and now gold all of a sudden is $15,000. Just to pretend overnight is $15,000 worth of reason. So what's silver worth? The higher gold goes in price, the more everything converges to nature. So at $15,000 an ounce, I'm going, well, I can't afford gold. What can I get? Well, there's only 10 times more silver than there is gold. So silver's worth 1,500. So I'll buy it. And when you have big moves like that, the market looks to nature. Gold going to infinity, to extrapolate, means no more futures contracts. No more futures contracts means no more rehypothecation. No more rehypothecation means silver's going to trade 15 to 1. I mean, it's not going to happen tomorrow, but that's the idea. It's going to gravitate towards nature.
The next phase of the precious metals cycle is being defined by structural scarcity and an approaching shift toward natural pricing. As gold moves toward significant sudden revaluations, the available supply for investment tightens, pushing the market away from leveraged futures and toward physical demand. In a scenario where gold revalues toward $15,000 per ounce, silver begins closing the gap rapidly, driven not by speculation, but by substitution. When gold becomes too expensive to accumulate, global capital naturally turns to silver, and the compression toward nature's 10-to-1 mineral ratio accelerates. That shift places silver in a trajectory where $1,000 to $1,500 becomes mathematically justified during extreme repricing cycles. Vince Lanci, a long-standing metals analyst and market historian, outlines how a gold spike of this size forces systemic recalibration. Reduced gold availability, BRICS accumulation, disappearing rehypothecation channels, and a retreat from futures-based pricing all strengthen silver's position as the next collateral asset. Spot markets gain priority, COMEX faces pressure, and institutional flows migrate toward physical-backed products. As the gold-silver ratio collapses toward 15 to 1 during crisis-driven revaluations, silver enters a phase where multi-hundred-dollar levels become part of a natural reset rather than speculation. Now, we present the clips from Vince Lanci's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
If gold revalues, whether it's a 50-year bond, and I don't think a 50-year bond would necessarily revalue gold higher, but it could, or China makes an announcement, we're going to use gold, we're going to give everyone gold. Whatever the reason, here's my answer. My answer is another framework. The less available gold there is to invest in, the lower the silver gold ratio goes. Okay, so why am I saying that? I'm saying that because in 2021, when John Paulson got back into gold, he said he admitted a couple mistakes he made before. And he said, I'm getting into it this time because the gold that's going to be bought in the future will not come back on the market. And there will be, as a result, less available gold to invest in. Meaning, paraphrasing Pozar, less collateral available, less gold to lease, more gold used financially for repo, which is going to come in China, I think. And the reason that affects silver the way I'm saying it affects silver is because when the world wakes up, not when it's in the process, but when it wakes up to the fact that there will be less gold available, it will start substituting. And when the substitutes start to happen, they'll happen in terms of nature. So here's what I mean. I'm in the dark, and now gold all of a sudden is $15,000. Just to pretend overnight is $15,000 worth of reason. So what's silver worth? I have no idea. Why was the gold bought? I don't care. I mean, I do care. Normally I care as a trader. But the higher gold goes in price, the more everything converges to nature. So at $15,000 an ounce, I'm going, well, I can't afford gold. What can I get? Well, there's only 10 times more silver than there is gold. So silver's worth 1,500. So I'll buy it. And when you have big moves like that, the market looks to nature. And I'm not I sound like I'm talking like a hippie, but I'm not. I'll be China for a second. What's the easiest market to move to its true price? The answer is gold, because it's not used, because it exists, because it's in nature, and because it's decentralized. We can hoard it, or whatever you want to call them. And once we do that, because it's organic, because it's a mineral, well, its mining is tied to other minerals. And so therefore, as it occurs in nature, it shall occur in humanity. Look, for the last 50 years, we've been operating under a neo-Keynesian mindset, which is infinite metals, infinite gold. We can just do we financialized everything. And so as the gold collateral disappears from availability, that makes people look for other collateral. Now, I'll give you a real example of that that's happening right now. In the BRICS nations, Eastern nations, are now, it's not obvious yet, but if you look, you can find it, are now buying silver. So the central bank in Saudi Arabia bought SLV. Now, are they going to buy it and sell it? Who knows? But they bought it. Okay. Russia is now accumulating silver, or saying they're accumulating silver for their central bank, which is basically like their critical mineral. There is no other collateral in the world. The Bitcoin conversation is different, but there is no other collateral in the world like gold except silver. You can't destroy it. You can't fabricate it. It's forever. It's fungible. There's no crop. There's no blue silver or red silver. There's just silver. And so therefore, and it doesn't rust and it doesn't get consumed. And so therefore, it is collateral. The question is, what's it worth? And so gold and silver are the two purest forms of collateral on earth. And that's why gold is perfect money, because it doesn't get destroyed. Silver is almost perfect money. And the problem with silver is it is used industrially, and that makes it worth even more when it gets going. So nature will kick in when gold goes up. That's it. That's my answer. Gold going to infinity, to extrapolate, means no more futures contracts. No more futures contracts means no more rehypothecation. No more rehypothecation means silver's going to trade 15 to 1. I mean, it's not going to happen tomorrow, but that's the idea. It's going to gravitate towards nature. SLV is a spot tagged market. COMEX is a futures market. So if you were to look at COMEX versus SLV, you'd say, oh, SLV sucks. COMEX will be saved versus SLV. And I'm saying no, it'll be the other way around. SLV will be saved because we're directing American investors into it. SLV is a security, and the U.S. will protect its domestic products, its SEC regulated products, its liquidity pool. The American liquidity pool of investors is one of the most valuable assets we have. The CFTC governs COMEX. And what is COMEX? It's a futures exchange with a lot of metal. And guess what? It's open to the world to buy, and it's a real pain in the ass. So we could be depleted that way. So eventually, I think COMEX gets delinked from silver before SLV does, which is probably controversial to say. But I say that now because spot markets are more important than futures, because the world is deleveraging financially, and because we need to protect or ring fence our liquidity pools. And to give you some proof of that, JP Morgan, they're the custodian of SLV now. JP Morgan's too big to fail. They're not the custodian of COMEX. They're the custodian of SLV. We have to protect that, right? The spot market is what's going to matter. There'll probably be new products as well. The spot market will matter. And by the way, new products, stable coins, blockchain, silver and gold, that's going to be tied to banks that have metal. So domestic supply must be protected. COMEX will go, I think COMEX will be triaged before SLV. That's my opinion. Now, let's pretend that I'm wrong, right? Let's pretend that I'm wrong. If I'm wrong, then SLV will become a tracking stock. They'll say we're not going to get any more metal. It'll start to trade like a closed-end fund. It'll track silver, but it will track at a discount. Will it go to zero? Yeah, it could go to zero, but you'll have bigger problems if it goes to zero than that. COMEX will go to zero first.
Silver is entering a structural transition that separates old assumptions from the new reality shaping the metals market. For years, above-ground supplies, industrial substitution, waste stream extraction, and steady bullion bank sourcing kept prices suppressed despite persistent deficits. That phase is ending. As global stockpiles tighten and financial systems shift toward collateral-based assets, silver begins moving along the same trajectory seen in lithium and uranium once they were designated as critical minerals. The early stages of this shift point toward a long-term valuation near $144, driven by government-subsidized demand, strategic accumulation, and tightening global supply chains. Once silver enters an exponential phase, price behavior becomes nonlinear, overshooting fair value just as dramatically as it undershot for a decade. Structural deficits, shifting collateral demand, and fiscal intervention create conditions in which temporary spikes above $200 and even higher become possible as momentum accelerates. Now, let's get back to the interview.
If stocks were to drop 10%, then silver would drop as well. Okay, it would move in tandem because for the next 1 day to 6 months, that would happen. And it would happen because the industrial demand of silver would decrease because you'd be fears of a recession or a depression or what have you. And it would decrease because even though it's monetary, it would not be linked to gold. Now, that's if the crash is purely a deflationary crash. If assets crash. Now, but we're increasingly more of a dynamic world. Suppose China's economy crashes. Does silver go down or up? I don't know the answer to that. I think silver could actually go down if China's economy crashed, and gold could go up. But we're not going to focus on that. I just want to say that the reasons for stock crashes now are diverse. If it's geopolitical, if the U.S. stock market crashes because China comes out and says, "Hey, we've got AI that's cheaper and better than the U.S.," then silver goes up. And that would happen because the U.S. would have to throw more money at it to compete. It would be more inflationary. We would just throw money at the problem, which is what we do. So it used to be an easier question to answer, and that answer would be, well, it'll go down at first, and then you buy it and it goes up. But the answer is, in a crash, if I know a crash is coming tomorrow, I sell, and I can only trade silver, gold, and copper. All right, let's look at it that way. If I know a crash is coming tomorrow and I can only trade silver, gold, and copper, I sell copper and buy gold. Therefore, what would I do with silver? Well, I don't know. It depends on the cause for the crash. So the answer is I would be flat silver, but it will probably sell off as well. It's a high beta version. It's a high beta stock. If all three metals drop to the lows on a crash, right, I'd buy gold. I wouldn't buy silver. And I might sell copper. Silver's not higher despite being in deficit for 5 to 10 years, right? The deficit's actually starting to decrease now. It's dropping the deficit is increasing at a slower rate now. So the acceleration is dropping a little bit. So the first question is, ignoring 2024 and a half to 25, why was silver not higher given the deficits? And the answer is, not being cynical about it, fundamentals don't matter until they matter, right? And fundamentals have been bullish for silver for quite some time. And they didn't matter because flows have been overwhelming silver. So, for example, above ground stocks. Look, before anyone mined silver, the banks, which are the biggest players, the bullion banks, yeah, and I could say that they're manipulating the market, and they are. They have been. But that was the market structure dictating that to them. But if I know that there's a problem in silver, the first thing I'm going to do as a bank, I know everything. I'm JP Morgan. I know everything about silver. All right. First thing I'm going to do is I'm going to go to all my nickel and lead producers, and I'm going to say, give me your scraps. And they're going to have leavings or you heap leach silver out of waste product, right? So they're going to pull that. I'm going to take that and I'm going to have more silver. And I'm going to keep relying on clearing out people of their waste product. And then I'm going to go to miners and by the way, this is what China is literally doing right now. China has been for the last year going around first to its own people. Hey, who's got piles of waste? I want the silver out of that. That's the CCP. And then they go into Latin America and they say, hey, who's got concentrate? I want it before it's refined. Give it to me. I'll pay for it. So that has been going on for years. And in combination with the fact that silver is heavily invested in by normal people, princes as opposed to kings, you have a lot of turnover at the coin area. So, I mean, at the investment area. And so above ground stocks, which have been able to be found, there has been much more than people understood. Uh, Cheap production, because you could just heap leach it to get more, and substitutability. You don't need silver for this. You can use less for that. And offloading, but the other one is offloading. So since the 80s, we've been telling central banks to sell silver, telling nations to sell silver, and that takes a long time to work through. I would say this to you that uh, the psyche of the silver market has been damaged for so long by such successful propaganda keeping it down that it takes a generation for it to be fixed. So that's why it has been the way it has been before this year, right? So 2025, in my opinion, is the beginning of that coming of age or coming out or generational turnover, the fourth silver turning, for lack of a better word. And so now you're asking, what are the drivers to $100 silver and when? Okay, I'm not going to answer when, and I'll tell you why in a second. And it's not a bad question to ask, but it's a foolish question if anyone answers, all right, for commodities. And I'll tell you why in a second. I am now mapping the path of silver higher on the same path that lithium and uranium have been on. And that path is uh, in 5 years, like my math, I actually did the math on these things. On my math, silver within, this is not crazy bullish tomorrow, but this is what's happening. Silver should be $144 within 5 years, period. $144. Now, why do I have that number? Because I did some regression. I said, well, when lithium became a critical mineral, what happened? When they announced uranium, what happened? Well, they announced silver. And what happens inevitably, without a doubt, is that demand gets subsidized domestically. Oh, we have to buy silver. Let's buy it. The government gives money to companies, spends money on companies to pull more silver out of the ground. Let's say that the government were to just say, all right, we're going to give $1 billion to a company to mine silver. Well, what does that do? That makes the price of silver go up. Even though we're pulling more silver out, the immediate demand has to hit the future supply. And that takes a lot of time. And so when you have a mechanism like that, critical mineral status, you look at critical minerals and how they acted before. And I'm looking at silver as compared to lithium and uranium. And I have a post on that. I've done the work on that and I've shared it. And it's actually done quite. People don't care about it. They want silver to go up to $100 tomorrow. But okay. I'm going to paraphrase something Keith McCulloch at a Hedge Eye said, and he said something that's near and dear to my heart, but he said it in a way that was very, very academic and very quant, and that was this. When you go into an exponential phase of a market, silver, I don't care what it is, it gets stupid, and you can't measure how stupid it gets. All you can say is, at every checkpoint, you look to see if the drivers of the stupidity are still there, right? And I don't mean to say buyers of silver are stupid. What I mean to say is, I say to you mathematically, fundamentally, $144 is worth what silver's worth. Let's pretend that I'm right. It's probably going to go to 250, right? So for the 20 years, through the 10 years that silver was undervalued from the fundamentals, it's probably going to be overvalued for the fundamentals. And that's the nature of silver. So when we get into a more exponential phase, that's the point. Exponential phases are not definable. It's like, the market hits a patch of ice and just starts to go. So it could go to, I can tell you go to $500, right? I'm not saying that, but it goes to $500. It won't be there for more than 5 seconds. You won't be able to sell. The sustainable real price over the next 5 years is $144. That's my number. Call it $150 if you want. So that's my answer. If anyone gives you a time frame, if anyone gives you a price, tell them why. Ask them why, which I just did. Here's my price. Here's why. It's a candle in the darkness. If anyone gives you a timeline, and that timeline is based on fundamentals, tell them they're morons. If they give it to you based on technicals, say, okay, I understand that because they have a timeline. If it doesn't happen, it doesn't happen. But generally speaking, anyone who gives you both a price and a timeline, laugh at them because it's a commodity and an exponential phase is an exponential phase. May as well flip coins and bet it's going to land on heads 10 times in a row. That's my answer there.
Silver is entering a phase in which structural forces finally overpower years of suppressed pricing and delayed fundamentals. The market is shifting from surplus illusions created by scrap recovery, waste stream extraction, and decades of official selling into a period where absolute supply tightness can no longer be hidden. Global buyers are transitioning from opportunistic accumulation to strategic stockpiling, treating silver as essential collateral rather than a secondary metal. As this transition unfolds, price behavior is primed to shift from slow normalization toward accelerated repricing, with long-term models pointing to valuations well beyond historical ranges. This next phase is driven by generational changes in market psychology, shrinking above-ground reserves, and the increasing role of silver in sovereign planning. Once momentum enters an exponential phase, the metal tends to overshoot, creating conditions in which triple-digit pricing becomes a natural extension of structural demand. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.